Hey everyone, so we're going to be continuing on with the FIN115 main exam. We're doing questions 3 and 4 to finish off the paper with the remaining 40 marks in the exam that we haven't covered from the last video. So question 3, as per before, what I like to do is just skim over the information and then look at what's actually required so that we know that we're heading in the right direction. So the first thing we need to do is calculate goodwill. Okay, the next thing we need to do is determine whether the two events above will impact the calculation of goodwill. Okay, so whenever we see goodwill, the first thing we need to consider is, okay, straight away, relates to business combinations chapter. Next, open up your journal templates and go to the section on business combinations. So this will tell you exactly what you need to do to calculate your goodwill. As well as the journals that you need to record. But does it ask us to record the journals? No, it doesn't. It just asks us to calculate the goodwill. So that's the only thing we need to do for the first question. So that makes it fairly straightforward. Okay, so let me just bring up the exam paper here. So there's a few things that we're going to need. So what I recommend we do first is we just put in our template over here. So we're going to need cash paid over here. We're going to need any contingency, I should say contingent consideration. Okay. And then we're going to need the NCI as well, value of NCI, and that should get us to our total consideration payable. The next thing that we want to calculate is fair value of net asset, and if we subtract the two, we'll calculate a goodwill. So goodwill acquired is B minus A, where B equals fair value of net assets less consideration transferred. So if we can figure out what these two values are, we should be able to figure out what our goodwill is. So to calculate for VINA, we need book value of net assets. We need fair value adjustments. We need contingent liabilities. That should get us to VINA. Okay, so if we can figure out those two, we should be able to answer this question. Okay, so let's pull up the exam paper over here. Okay, so let's just look at the information in here. So cash consideration paid, I can see is 5 million over here. So we can put that in, 1, 2, 3, 1, 2, 3. Okay, is there any contingent consideration? Let's have a look. So I can see further cash payment of 500,000 if it achieves profit after tax. At 1 January 2014, both parties that were confident this target was achievable, and a fair value of 300,000 was assessed for this payment. Okay, so we need to include the fair value of the payment. Okay, so let's include the $300,000 amount there in our contingent consideration. Okay, so let's put in the 300, 1, 2, 3. Okay, and then the value of NCI. So we can see down here the value of NCI at 1.8 million. So let's just include that in there. 1, 2, 3. And then sum all these up, and we get 7.1 million. Okay, so now we need to calculate the book value of the net assets. So that's 6.9 million over here. 699, 1, 2, 3. Okay, fairly straightforward. Then we need to go do the fair value adjustments. So because sometimes in your balance sheet you're not recording things at the current value, and this is just to make sure that upon transaction, you actually record everything at the fair value. Okay, so are there any fair value adjustments in here? The book value, cash payment, doesn't look like there is in the question. Okay, so we'll put this at 0. And finally, let's look for contingent liabilities. So can you see any contingent liabilities in here? It looks like there is a $1.5 million potential liability. However, we need to adjust it to fair market value, which will incorporate what's the probability that we'll actually pay it out. So let's see if there's any adjustment for that. So Ausden would have needed to pay $1 million, which would be tax deductible for Ausden for a third party to assume responsibility. Okay, so the amount that we need to actually recognize is the $1 million, because if we were to raise the provision for that, that's the amount that we would actually have to pay out, not the $1.5 million. So we're going to use this number here. However, there is actually one adjustment that we do need to make to this number. But there's two things that I want to talk about with regards to contingent liability. So I'm going to pull out the notes over here. So the first thing that I want to talk about is the fact that that ordinarily we wouldn't actually recognize contingent liabilities as an asset on the balance sheet. It's just for specific requirements under IAS 37. That's the first thing. And the second thing that I want to point out is that for the purposes of the FIN module, the module assumes that there is a temporary difference which will arise for income tax where there's a fair value adjustment, and this is applicable for contingent liabilities as well. So effectively what we need to do is reduce this by the tax rate. The reason is because we're going to get a tax deduction for it, so there's going to be a tax benefit for that as well. So we actually do need to reduce the amount in the exam, the $1 million, by whatever the tax rate is. So the tax rate over here is 25%. Okay, so just keep that in mind for any fair value adjustments to asset or contingent liabilities. We need to adjust for tax as well. So it's not just the $1 million. Okay, so the figure that we're going to put in our calculation is actually the $1 million. This is probably the only tricky part of the question. The $1 million less the tax rate. So the tax rate was 25% per the question. So I'm just going to times it by 75%. And there we go, the $750,000 right there. Okay, so have we done it the right way around? So actually it's a liability, so we need to reduce this. Because if you think about it, the fair value of net assets is, well, it's the assets less liability, so we need to have the value of our assets less liabilities. Okay, so let's add that up. So we're going to get 6.150. So if you remember from before, to calculate goodwill, all we have to do is subtract the consideration from the fair value of net assets. And this makes sense. How you remember this is because goodwill represents the premium that you're paying on the underlying assets of the business. So if the underlying assets of the business are only worth 6.1 million and you're paying 7.1 million, then the premium you're paying, or the goodwill, is the $950,000. So that's all you need to get full marks in the first question of the exam. So you're going to get 4 marks for that. So you're going to get probably 2 marks for calculating the goodwill figure correctly. You're probably going to get 1 mark each for calculating the consideration and fair value correctly as well. Okay, so let's go through the next question now, which is whether or not the events above will adjust the impact of the calculation of goodwill at 30 June 20x5. Okay, so for this question we have to talk about adjustments to goodwill relating to events after settlement date. So if you look in your critical file notes, you'll see that it relates to this section here, which is called measurement period adjustments. And what this is basically immediately after you buy the business on settlement date, you have to do your balance sheet accounts. However, IFRS gives you 12 months basically to change it or update it for any changes which have arisen. Anything after those 12 months, you cannot change your goodwill figure, only in the event of an error. and that's accounted for retrospectively. But if there's new information after 12 months, you can't change goodwill, you just have to expense it. Okay, so a few other things about this is it must actually relate to pre-acquisition information, and that information must must be, for example, you bought your business and you're just waiting for information relating to an event pre-acquisition. You can adjust your goodwill for that. If it's relating to new information after settlement date, you can't adjust your goodwill. Okay, so let's have a look at the question. So it's saying, first one relates to its earnout period. So it's saying actual profit for the 12 months to December for Austin was 2.25. So therefore, further $500,000 consideration was not required to be paid. So this is basically asking us whether or not we need to adjust the contingent consideration amount that we included in our consideration of $300,000, because that was the fair value. So the answer is actually no, we don't need to change it. The reason is because it relates to events that have arisen after acquisition date. So it's not an event that had already occurred pre-settlement that we're just getting new information on, which would be okay to update. This is actually new information arising after settlement, so we can't adjust goodwill for this amount. So you get 1 mark for getting the correct answer and 1 mark for the explanation. Now the next thing is the lawsuit down here. So the lawsuit was something that existed pre-settlement, and we actually included an amount in here, the $750K contingent liability for the lawsuit. So it did it was a pre-existing event, so we've just got some new information on that, and it's within the 12-month period. Now keep in mind, if it happens after 12 months, if that new information comes through after 12 months, we can't change goodwill unless it's for an error. So we're saying lawsuit was finalized 31 October, Austin was found not liable for any charges. So the only issue is, was this date within 12 months after settlement? If it was, then we can adjust it, or we have to adjust it. So settlement was on 1st of Jan, so 12 months after that will be 31 December 20x4. So this date, 31x4, is before 12 months afterwards, so yes, we can actually adjust our goodwill for this. So we need to discuss the impact on the calculation and the reasoning. So we've discussed the reasoning. Let's talk about the impact on goodwill. So basically what's happening is so we previously included a contingent liability. So we can see that this amount here, if we delete that out, which is what we would do, is going to decrease our goodwill. Okay, so it's going to decrease our goodwill from $950,000 to $200,000. So that's your other mark to get full marks on this particular question. Okay, so that was pretty straightforward so far. Let's have a look at part B to question 3. And again, I'm just going to skip ahead and look at this. So prepare the journal entries using equity method of accounting and the consolidated financial statements of the Raptor Group in accordance with investment in associates and joint ventures. Show all workings. Okay, so I did a pretty good video explanation on this in the module courses above, talking about what the equity method of accounting is. So I recommend just watching those videos so you get a better understanding of the different types of consolidation. Okay, so go and watch that first so you understand it, and then once you've watched that, come back and we'll go through the method of how to approach this. Okay, so let's go through this third question now that we understand what we have to do. And you've hopefully watched the video so you understand what accounting using the equity method for acquisitions is. So at a high level, what we have to do is just report our minority interest, because it's a small percentage, just in a single line in our balance sheet. Now, we also need to reverse out any intra-related, revenue as well. We need to eliminate the dividend revenue, for example, and so forth. So, generally, as a first step, what I would do is open up your journal templates in your notes and go straight to Unit 17, Equity Accounting. Okay, so this tells us exactly what we have to do. So first of all, I mentioned before that this is all going to be just recording the asset as a single line, which is our goodwill, as opposed to including all of the balance sheet and all of the revenue consolidated as you do when you own a majority interest. You don't do that. You just include a single line, which is your cost of investment, your goodwill in your investment. And then these are the dividends that we need to actually record, and we're going to need to do this investor's share of current profit and loss, acquisition movement reserves, and opening retained earnings, okay? But fortunately, we just follow the structure and it should help us get the right answer using this template. Okay, so the first journal that we need to do is, you can see the one with the number 1, is to eliminate dividends from investees. So what I'm going to do is, first of all, I'm just going to write out all the templates that we need, and then we're going to go through and actually add in the numbers from the exam. Okay, so don't forget to put in the dates when you do them as well. I'm going to skip over it, but just write it something like this on all of your journals, so you've got the date there, X5. Okay, so the first one we need to do is eliminate dividend revenue from the investee. Okay, dividend revenue, investments in associate. What also helps is you actually add a description as to what the journal does if you have time in your exam. So we're just going to write down the bottom of it to record the elimination of dividends received by investor. Okay, so this will just help you help the marker understand what you're trying to do with your journals if there's any uncertainty. Okay, so the second journal that we need to do is the investment in associate, so that's number 2 down here. So we can go investment in associate, and then revaluation surplus retained earnings. Okay, and then okay, so that's our second one. And our third one, oops, sorry, we're missing one. I'm just going to split this out into this. Earnings. Okay, cool. I've just split out retained earnings and revaluation surplus in case there's anything else in the question that would fall in retained earnings, not surplus, but it would still impact your investment in associate. Okay, and then finally we need a template over here, which is just to record the investor's share of profit and loss, acquisition movements and reserve, opening retained earnings. And again, if this is confusing for you, just copy the table, have a go, and most likely you're going to get the right answer anyway. But as you're doing it, as you're going through the process, it'll make more sense, especially the more that you practice it. Okay, so what I'm going to do is I'm now going to copy these, but in your exam you'll obviously have to write them out. So we're going to go item, post, AC, opening, retained earnings, write it out in full in your exam, and then current year profit after tax. Okay, cool. Excuse my misspelling. Okay, so we'll come back to that last bit. Let's focus on the journals for now. So the first one's just dividend revenue. Because it's an interrelated party, we need to reverse it out. Otherwise, it's not real revenue if you're just selling it to a related party. So we need to figure out, okay, so what's the dividend paid? So I can see there's an amount here, dividend paid of $7,000. So we need to reverse this out. We only want to reverse out our ownership of that, the 30%. Okay, because the other percentage is going to the other shareholders who's not a related party. So what's 30% of 700? 10% is 700, and 30% would be 2,100. Okay, and revenue is ordinarily a credit, but if we're going to reverse it out, we need to put it as a debit. Okay, and then the other side is obviously going to be a credit as well. Okay, pretty straightforward. The next thing that we have to do is the revaluation surplus. Okay, so we've got an amount here, the 67,500. So let's just figure out what that is. Okay, so keep in mind we only need to calculate, as per the notes, is that we need to calculate the post-acquisition surplus. Okay, so we know that the opening balance was 60,000, and we know the closing balance was 67,500. So that means the post-acquisition component would be the difference of the two, so $7,500. 7,500. But of course, we also need to times that by our ownership percentage, so that's going to be $2,250. Now, the other thing we need to do is the revaluation retained earnings. Oh, and by the way, the debit is because a surplus is usually in an equity account, so therefore it's credit. We're reversing it out, so therefore it's debit. Okay. Now, for the revaluation of retained earnings, let's have a look over here. Okay, so I'm going to come back to this one. I might actually split it out into a different journal as well. Okay, so I've just split it out into two different journals there. The reason being is we're actually going to need this table down below to be able to calculate what this value is. Okay, so we're going to come back to these amounts here. Okay, so let's go back to our exam Bible template. So this is to record the investor share of current year profit and loss, post-acquisition movements and reserves, and opening retained earnings. Okay, so the few things we're going to need is so opening retained earnings, which in the exam would be so keep in mind we only want the post-acquisition component. So if you think about how retained earnings is calculated, it's basically profit for the year. So the year we bought it on 1 July. So the opening retained earnings would be the profit for the year between 1 July and 30 June 2014. So you can see that amount down here is $35,000. So let's include that in there. Okay, so the next thing that we need to do is include the current year profit after tax. Profit after tax. So we've got our opening balance of retained earnings. We then need our profit for the year after, which would be this one here, so the $60,000. We're going to put it in this column over here because we've actually got it written as current year profit after tax. Again, if this is confusing, just keep following that template. It's going to tell you the right journals, and as you keep doing them, it'll make more and more sense. Okay, but we also need to adjust our current year profit for a few things in the exam. Just have a look through and see if you can find any P&L adjustments to that current year profit that we need to adjust for. Okay, so there's something in here. So it's saying that at acquisition date, all assets and liabilities were stated at fair value, except for the exception of item of plant, which was quoted at $10,000 below its fair value. At 1 July, the plant had a further year life, which was being depreciated on a straight line basis. So what this means is that depreciation is actually factored into that current year profit. And because of that error, we need to actually adjust that to correct for it. Okay, so the first thing we need to do is figure out what the incremental depreciation adjustment would be. So because it's $10,000 below its fair value, we need to increase the value of the asset by $10,000. And it also means that we need to increase our depreciation as well. Because it's got a 5-year life, it means that the depreciation has been understated each year by 10,000 divided by 5, so 2,000 a year. Okay, so what that means is we need to adjust our profit by $2,000 a year less any tax. Okay, so the tax rate in this question is 25%. So we need to adjust our net profit after tax by it's 10,000 divided by 5 times 1 minus 0.25%, which is the tax rate. Okay, I've just corrected my formula there. Okay, so we've got an adjustment. Now, have we got this the right way around? Currently, it's adding to our tax, but what it means is we've been understating our depreciation, so we actually need to reduce our profit for the year when we make this adjustment. It also means we need to adjust the previous year as well. Now, keep in mind, we're only caring about post-acquisition, so we've had 1 year of post-acquisition completed as well, so we need to adjust last year's as well. Okay, so let's look for some further adjustments in here. So we've got there was a sale of inventory during 30 June 2015, so current year, with a sales value of 10,000 and a gross profit of 3,000. All of his inventory was still on hand in the books of Raptor as at 30 June 2015. Okay, so basically what we need to do here is adjust out this profit. So similar to how we adjusted our dividend income already, we need to adjust this profit out from our current year's profit after tax. Okay, so the way we calculate this is it's basically just the 3,000 in the current year only. So we're going to go minus 3,000 because we want to reduce our profit, and don't forget tax. So we're going to times that by 1 minus the tax rate, 1 minus 0.25. Okay, so minus 2250. Okay, so that looks like the last adjustment we had to make, which means that we can calculate our adjusted retained earnings balance. So we're going to sum up these two. Okay, and then of course, this is at 100% of the business, remember? So we actually need to only calculate what is the investor, so Raptor's component of this. So we just want to times this by the ownership percentage, 30%. So times that by that. Okay, cool. So now we've got two things. So number one, we have got the adjustment for the retained earnings up here. Okay, we don't need to adjust current year profit after tax, just the previous year retained earnings. So let's put that in now. Equals that, and then that equals that. Okay, perfect. So that's pretty much everything you need to get full marks in this question here. We've got 12 marks for this question, so you'll probably get 2 marks for each question, so 1, 2, 1, 2, 1, 2, so it'll be a combination of the correct journal plus the correct amounts. So we've got 6 marks there, plus probably another 6 marks for your calculation down here. Okay, cool. Now we're on to question 4, almost done with the FIN115 exam. Alright, let's quickly skip to the question to see what it's asking for it. Okay, so it looks like each item of our prepared journal for the accounting treatment, including a deferred tax effect. Okay, so this question's got a little bit of a few different things in it. The first 2 ones are just around property, plant, and equipment, and actually revaluing that. Okay, so we're going to need to prepare the journals for each of them. So what I've done just first of all is just to bring up the exam Bible template for Unit 7, Property, Plant and Equipment. Okay, so there's a few tricky bits around this. It basically, the choice of journals depends on what the prior adjustment in the P&L was for fair value for the revaluation. So if the revaluation was a prior decrement that is larger than the new increment, you'd use these ones. If the prior decrement is smaller than the new decrement, you'd use these ones. If there was no prior decrement, you'd use these ones. And if there was a previous valuation which is greater than the new decrement, you'd use this one. So it is a little bit tricky, but all the journals are there. You just need to figure out which one it is that you need to use. Okay, so the first step before we do any revaluations for property is to actually reverse the accumulated depreciation on the revaluation of PP&E. If you need a bit of a catch-up video, make sure you watch the revaluation video in the core content modules. So let's put in our journal, so make sure to include a date, description, debit, credit, dollar values, and a little bit of a overall description of what the journal's doing, just as best practice. I'm not going to do that in the interest of time. What I'm just going to do is copy the journals from the exam Bible. So I'm just going to go like that. Okay, that didn't work. Account, debit, credit. But just make sure that when you're actually doing the exam that you fill it out in detail so that you can get full marks if in doubt. Depreciation, PP&E, okay, I'm just going to copy this text over here as well just to provide the markers and background. If you don't have enough time in the exam, don't worry about including this, but it is best practiced. Okay, so what's the accumulated depreciation reserve? Less 1.2 million accumulated depreciation. So there it is right away. So basically, we need to get rid of that accumulated depreciation, bring it back up to cost, and then after that, we can put in our fair value market adjustment. So what we want to do, because accumulated depreciation was previously a credit, we want to reverse it and put our 1.2 there. Okay, so that's the first journal done. The next thing that we need to do is actually figure out if the previous decrement was what it was, so we can figure out what approach to take. Okay, so the carrying amount previously was this. Okay, so the previous decrement was 16.8 million down to 11.6 million. So that means the previous decrement was a reduction of value of $5.2 million. Okay, so what we're trying to journal is that we're revaluing the property from 16.8 to 11.6, which means that we want to devalue it $5.2 million. Now, what's in the revaluation surplus is $5.8 million. So what that means is, because the $5.2 million is less than the $5.8 million previous surplus, it means that we're going to have to use these ones here because the previous is greater than the new decrement, if that makes sense. So we're going to use these journal templates over here. So let's quickly do those. So we're going to go revaluation surplus. Don't forget to put in the dates and the amounts and the debit and credit. I won't do it here just for sake of time. Then we also need DTL, and we also need PP&E. Okay, so the easiest one of these journals is PP&E, because what we need to do is reduce the value of the property 5.2 million, which is the difference between that and that. So straight away we know this one here is 5.2 million. The next thing that we want to do is just calculate the DTL. because the revaluation surplus is going to be the difference between the total reduction and the tax value. So to calculate DTL, it's effectively just that times the tax rate, and in this question the tax rate is 28%. So we're going to go equals that times 0.28. Okay, and then revaluation surplus is just the difference. Boom, done. Okay, so this question is done for question 1. Question 2. Okay, next up with number 2, we have capitalized 800K of development costs. So they've spent the money which have been recognized. So they've capitalized it sitting on the balance sheet, and they've spent the money. So the project is not yet at the stage where amortization should be charged. So they haven't actually put anything through the P&L currently for amortization, because it doesn't satisfy the requirements. However, for tax purposes, there are going to be a deduction, because development costs are deductible when the expenditure is incurred. So this is going to create a timing difference between what they're getting for tax, so they get a deduction of, or they'll pay a lower tax rate, versus what they're recognizing on their P&L. So that means we need to put it in an adjustment for that income tax expense, and the deferred tax component of that as well. So they're going to get we're going to put through a income tax adjustment, which is the deferred tax liability on the development costs. So let's journal this in now. So there's going to be a income tax expense, so we're going to go DTL to recognize the future tax liability of equals 800, 123 times 0.3, and then equal that 224. Sorry, it's not a flat 30% tax rate in this question, it's 28%. So let's just change that, 224, yep, cool, and there we have our answer. So that's the deferred tax liability on development costs. Okay. And also, when you're doing your exam, make sure to put in your reference question, so we know that's question number 1, that's question number 2, and so forth. And also put in your dates and your description of the journal as well, which I'm not going to do here for time. Okay, so for question 3, okay, so reading through this question, we can see that they've held plant and machinery that's no longer of use. So the assets meet the criteria for held for sale under IFRS 5. The carrying value was 2.5, and they've got a sale agreement cost us 100 grand. Okay, so your first reaction when you see held for sale and you're not quite sure where it sits in the notes is, well, the CA program tends to group questions together. So because our first question is property, our second question is property, most likely this held for sale is also in the PP&E chapter. So the first thing to note is when I find the relevant chapter PP&E and then look for held for sale in here, we can say that under the IFRS 5, which is non-current assets held for sale and discontinued operations, that when it is held for sale, it is measured at the lower of cost of carrying amount and the fair value less cost to sell. So this is all we really need to know for this question. So we need to figure out what is the lower of the carrying amount and fair value less cost to sell. So we know the carrying amount per the question is here, 2.25 million. And the fair value less cost to sell is, well, we've got in the sale agreement it's worth $800,000. And we know that the cost to sell at $100,000. So that means that the fair value less cost to sell is $700,000. So now we're comparing the 2.25 with the $700,000. The lower amount is the $700,000, which means that the loss on the classification as held for sale to be recognized through profit and loss is going to be the difference between the two. So So there's not actually a journal in here for this particular case because it's very unusual, very unique situation. So what we're going to have to do in this situation is just think logically, okay? And it's not going to be that hard to complete. Okay, so the first thing that we need to know is, well, we're no longer... So held for sale is a completely different category, basically, of asset to PP&E. So we need to reverse out the PP&E entirely and recognize it as a held for sale. And any difference is going to be reported as a loss or gain through the P&L, basically, depending on which way it goes. So let's just think about this logically, okay? So we've got our debits and credits. So the first thing that I want to acknowledge is that the PP&E balance is going to be reduced by the entire carrying value. So we're going to go 2250,123. Okay, so credit that. The next thing that I want to recognize is that we need to then reallocate it as held for sale asset. Okay. So if you remember a second ago, we just worked out that this would be 700,000 because it's the lower of the carrying amount or carrying value and the fair value less cost to sell, so it's $700,000. Okay, which means that the loss on this, the difference, loss or gain, is going to be that minus that, which is equal to 1.55 million. And because it's a debit, it's going to be a loss on reclassification of HFS expense. That's pretty much all you need. Okay. Now, the other thing to consider always when you're doing a revaluation journal is what's the tax impact, because everyone forgets this, right? They do this journal, it's pretty logical, it makes sense, not too hard. People always forget the tax. So whenever you do a journal, think, have I got a DTL component in the journal? If you do not, then you're probably missing it, because if you look at the journals above, we've got a DTL. If you look at this one here, we've got a DTL. We don't have a DTL here. So just remember, any revaluation question, make sure we've got some sort of tax impact included in here as well. Okay. So how do we approach this? So the tax rate, so we're going to have a loss, right? So generally, when we're going to have revenue in the P&L, our tax is going to go up, and then we'll have a DTL. In this case, our revenue is not changing, but our net profit's going down because we're increasing our expense. So what's going to happen is you're going to get a DTA instead of a DTL. So we're going to put DTA, we're going to go equals that, the P&L impact of the 1.55 million. And then we're going to times that by the tax rate, which is 0.28. Okay, and then the opposite side of DTA is income tax expense. I know it says expense, but it's a credit. So it's just we just have to say that because it's a P&L line item. And yeah, that's pretty much the answer to question 3. Okay, so let's go to question 4. We're almost at the end of the paper. Question 4. Okay, so this question is about an interest rate swap that they've entered into, and how do we account for that? So your first response when you say interest rate swap, immediately you should be thinking financial instrument. Okay, swaps, derivatives, futures, they're all financial instruments. So whenever you see that keyword, go straight to your notes on financial instruments to figure out how best to account for them. Now we can see in the question over here, they've actually told us how they're classified, which saves us having to go through this flow chart over here. So they're classified as fair value through profit and loss. So that makes it easy for us. All we need to do now is go to our financial instruments section of the exam Bible. Here it is here. Look up accounting for fair value through profit and loss. Here we go here. Okay, so let's have a think about this. So there's no cash paid for the investment, so it's going to be 0, 0. There's no transaction expenses in the question, so it's going to be 0, 0. Accrued interest not applicable when interest is paid. But we do need to recognize where there's been a gain or loss on the fair value through profit and loss, because we know that the fair value of the swap per the question is $26,000 over here. So the first thing that we need to do is go, so it's actually a liability, not an asset, so we know this is a credit. So we're going to go investment, or instead of investment we're going to call it the interest swap liability, because it's not an asset, it's a liability. We're going to go 20, well, I should say it's 26,000 because it's in the credit column. And the other side per this is hitting the P&L. So what we need to do is call this the loss on reval of ISL, and then we're going to link that to that. And then of course, what did I say before on the last journal? What's the tax impact? We always need to consider the tax impact. So because it's a negative, it's basically the same journal as before. So we're going to go times 0.28, and there's our journal right there, times 0.28, and it's a DTA because it's the net profit's going down rather than increasing it. Okay, so there's all the journals that we need to get full marks on question 4. And then let's just quickly close off the exam by going through the last question here, which is number 5. Greymouth issued share capital on 30 June 2015. The shares were issued for cash of $800,000 and $75,000 were incurred. The $75,000 in tax costs are tax deductible in the year they are incurred. So okay, in this question what we're going to do here is share capital of 800,000 minus the costs of incurring, and then this one's going to equal the same because you're getting an injection of cash. And that's it. That's the end of the paper. That's how you get 100% on every single question for the FIN115 main exam. I hope you found this very useful. I'll continue to add more exam papers and solutions to get 100% on each of the papers. Keep doing exam papers until you've learned all the tricks, because they do tend to repeat the same types of structures of questions. They might have a sample pool of 100 different types of questions. We've just covered off probably 8 different types of questions, so you'll need to keep doing exam papers over and over. So in the next exam you might have 1 overlap of question and another 7 questions, so you've got 15 total. So you might need to do 5, 6, 7 exams, and then you've covered every type of question they could possibly ask you. So just keep doing exam papers, learning the techniques, tabulating your notes so you can quickly, speed is really important, so you can quickly get out these answers. And yeah, good luck.